Everyone, my name is Brian. I'll be presenting today with my fellow colleagues Caesar and Travis on the stock market panic of 1907 and how it affected financial institutions at the time and led to the creation of the Federal Reserve. To start off, we'll be going over the topics that we've been talking about today, such as the before the panic of 1907, the market reaction, the outcome, and role of key figures such as JP Morgan, and the legislation enacted due to the panic of 1907, and we'll be ending with the key lessons. Before the panic, it was a bull market. Many industries were booming. And one example will be Heinz and Morse in the copper industry that were trying to purchase the entire United Copper stock. And they were backed up by the Knickerbocker Trust Company. And when their attempt failed, it led to the stock dropping quickly. And many investors were using margins and leverage and loans to purchase these stocks, leading to them being selling quickly actually, leading to volatility in the market. And we will be talking about this throughout the presentation. Some warning signs that investors ignored were not looking at valuations of the company, their financial statements, and not following fundamentals such as looking at the valuation of each company. And also the financial institutions had a role by being overconfident in loaning out most of their cash reserves and their deposits that they received, and not and then followed by not having any transparency or regulations at the time to aid them or to kind of stop these attempts by individuals such as Heinz and Morse. Some key players that led to the crisis and actually helped the crisis will be JP Morgan, one of the biggest bankers in America at the time. And he was known as someone as closely looked at as the reserve at the moment. And then the company that actually started the entire panic of 1907, the Knickerbocker Trust Company, who took huge risks with bad investments, such as the Heinz and Morse, that led to them not having the back to be able to pay back their deposits, and many individuals tried to get their cash out. It led to a bank run, and since they were not able to meet that demand, unfortunately, in October of 1907, they had to shut down and causing mass chaos in the markets and in the economy. One individual that's overlooked is Charles M. Schwab, who was in the U.S. Steel, which was one of the biggest industries at the time, and he helped J.P. Morgan to help and create certain fundamentals and enact certain laws to help at the time help alleviate the panic of 1907. Some key reasons for the market panic after the central bank authorities, there'll be the Federal Reserve. If there was a Federal Reserve, they would have stopped immediately. Knickerbocker Trust Company would have received the bailout. They will be able to pay back their loans, such as the FDIC's insurance of today. And many investors just looked at the market as too lucrative. And speculation drove high, just mass investing with margins, and led to them not being able to pay back their loans and stopping cash flow from any of these trust companies. I'll be handing off to my colleague Caesar.
So I'll be talking about the institutional fragility and public panic. The slide highlights the fragile nature of trust companies leading up to the panic of 1907. These institutions were lightly regulated and often operating without strong oversight or sufficient reserves. When the panic hit, their instability triggered widespread fear, and what followed was that the institution stumbled and public confidence collapsed across the entire financial system. The cartoon illustrates banks extending too much credit fueled inflation with the imbalance of economic scale. With no strong safeguards in place, fear had spread quick, pushing people to withdraw their money and amplifying the crisis. We can see here in the market reaction that the Dow Jones dropped nearly 15%, which is a huge plunge. that concerned investors and it froze the financial system. People weren't selling by choice, they had sold because they had to. And borrowing costs have skyrocketed. Investors who relied on call loans, short-term loan lenders could demand back instantly, saw that interest rates surge from low levels to just about 100% spike, which trapped investors and either had to find cash quick or dump their stocks into a crashing market. And the result of that was collapsing asset values and soaring capital costs. After the stock market crash, panic turned to the banks without central banks to stabilize the system. Fear spread quick, and people rushed to withdraw their savings, not just in New York, but across the country. Uh, in desperation, the country turned to JP Morgan, which is a private banker. He gathered top financial professionals and organized emergency loans and approved key mergers to stop the system from collapsing, and his plan did work. It became clear that the US needed a permanent centralized solution. The crisis directly paved the way for the creation of the Federal Reserve. As the panic deepened, public trust in banks collapsed. People rushed to convert their savings into tangible assets like gold and cash. Mostly due to the fear that was going around. Banks couldn't keep up, so they had some limited withdrawals, and others had shut down entirely. It wasn't a local crisis, it was nationwide. In this chart, we see how severe the 1907 liquidity crisis became. On October 4th, 1907, the daily call loan interest rate cost of borrowing for short-term money surged incredibly huge. It spiked up just about 100%, which meant investors were paying double their loan amount in just one day to stay in the market. Credit markets had frozen completely. Lenders refused to lend. Banks hoarded cash. Even basic financing became expensive or unavailable. And it wasn't just one day spike. Rates stayed high and volatile for months. The wake-up call led to the creation of the Federal Reserve in 1913, giving the government the tools to stabilize the banking system and respond to the crises. But it also revealed the systematic risk. Banks weren't isolated, they were interconnected. Uh, just one failure in New York caused the panic to spread across hundreds of banks nationwide. The whole crisis had reshaped the financial system, and there was ways of stress testing and systematic oversight, uh, in which launched the modern era of financial policy. Of 1907 didn't just lead to the Federal Reserve, it triggered long-term shift in how we handle financial risk. Before the crisis, the US had almost no financial oversight, few rules, little transparency. But after that panic, everything changed. Policymakers pushed for stricter regulation, minimum reserve requirements, standard reporting, and real accountability.
Sector. The Panic of 1907 forced the private sector to rethink how it managed financial risk. First, banks and trust companies put more emphasis on liquidity. The crisis showed profitable institutions could fail if they didn't have enough cash. Second, much stronger clearinghouse loan systems, which were temporary forms of currency between banks to help in a crisis. Lastly, the coordination of institutions, because going it alone is not stable enough. JP Morgan. So during the crisis, there was no Federal Reserve or government assistance when it came to failure in the financial system. Morgan stepped in as a central banker and gathered every major bank and trust to work on a rescue. This restored confidence and prevented a larger freefall. His involvement was a great short-term solution to the problem. Charles M. Schwab. He was the president of U.S. Steel during the crisis. Tennessee Coal and Iron Company used their stock as collateral for loans. With the crisis occurring, these businesses would freefall. He stepped in to merge and acquire Tennessee Coal and Iron company. This bypassed the antitrust laws, but with clearance from the president, he helped stop the free fall. This helps stabilize blue chip equities. Legislation enacted. First was the Aldrich Vreeland Act of 1908, which allowed banks to issue emergency currency during times of crisis. Then the National Monetary Commission was formed, and this was formed to study financial stability worldwide. More reforms arrived in 1913 with the Federal Reserve Act. This created the Federal Reserve System, which is allowed to act as a lender of last resort, regulate money supplies, and oversee the banking system. This shift towards centralized financial oversight, which is very much needed to keep risk minimal at a national scale. Key lessons. To wrap it up, central banks are essential for financial stability. Without them, the financial system cannot self-correct during times of crisis. Confidence is a core currency in banking. When confidence is lost, people fear the worst, and this breaks down institutions overnight. Private sector solutions are not sustainable. JP Morgan was only a short-term solution to the system failure. Relying on them is very risky. Finally, regulation must evolve with market complexity. The structure of regulation only worked for the market in the 19th century, but as it evolved, it needed more regulations to keep up. This is our bibliography. Thank you for listening.